Today I want to talk about how these big banks or these central banks are preparing for the squeeze and hedging against the shorts by going long on AMC. Now, I don't actually think these central banks like the Swiss National Bank and the Fed can actually afford to bail out these major banks, and today I'm going to explain why. So stay tuned and let's make some money. And now I'm going to dive straight in with the key information. So, Peter Han posted on LinkedIn saying it's the weekend, which means my brain has far too much time on its hands. He said, I've noted previously that Credit Suisse has been quite active in shorting AMC, especially in 2021. He says, I still wonder about possible Archegos connections and if they're still holding the Archegos short positions on AMC and GameStop. But leaving that aside, it's clear that Credit Suisse has continued to have an interest in AMC. And of course, their latest equity research report trashed AMC and gave it a 95-cent target on fundamental decline in theatre goers, practically begging us to sell our shares on the cheap. He said, but it's odd they haven't covered Cineworld lately or many other failing stocks, which, despite in restructuring talks, saw their share price actually rocket on the bankruptcy announcement. He said, anyway, the point of today's post is that last year, a month or two after the Archegos debacle, and after Credit Suisse had been very active in selling and shorting AMC, the Swiss National Bank filed a 13F report with the SEC showing an ownership of AMC shares, a position they later added to and continued to hold. We can see the Swiss National Bank is actually one of the 20 largest AMC shareholders with 2.2 million shares. Now, the most fascinating thing about this is their average share price is actually $32 per share. The Swiss National Bank is currently down over 80% on the shares they've purchased, but they're still holding all of those shares and they haven't held a single one, almost like they're holding these millions of shares for a specific reason. He said the odd thing is the Swiss National Bank never sold those shares on the run to $72 and never in the months that followed when it traded in the $35 to $55 region or now down at the sub $10 level either. He said in his History Channel narrator voice, was this a hedge against the need to rescue Credit Suisse from an AMC short position that they could not get out of, or perhaps Archegos related? Cue dramatic music. And he also asked, hi Credit Suisse, I have a wonder. If your equity research department thinks that AMC will go to 95 cents per share, why has the Swiss National Bank not sold their AMC shares they bought last year when the price was significantly higher? Does the Swiss National Bank not trust your analysis, or is it a squeeze hedge? Now, I think this is a really interesting possibility. The Swiss National Bank is actually hedging against the actions of these shorts or of these major banks like Credit Suisse by going long on AMC and not shorting it alongside them. Now, I want to pose the question and answer the question, can the Swiss National Bank not actually afford to bail out Credit Suisse if they default during the squeeze, unless they benefit from the squeeze themselves? Does the Swiss National Bank or maybe even the Fed not actually have enough money right now to bail out these major banks unless they generate billions or trillions of dollars from an AMC squeeze? You may say, Tom, surely central banks like the Swiss National Bank or the Fed are very well capitalised and can afford to give out any bailouts they like. But don't forget, these central banks have only very recently given a massive bailout during the 2020 pandemic. Inflation has skyrocketed and bailing out major banks would be even more inflationary, causing an even higher inflation rate, potentially wrecking the economy even worse. Back in 2008, bailouts weren't offered to Bear Stearns or Lehman Brothers and were only offered to prevent the entire collapse of the financial system. I think this time round, considering they've just recently given massive bailouts, they can't really afford to do it again. Just a quick one, guys, if you haven't already, be sure to join the free Discord linked in the description below. We've got 1348 indicators and we talk about AMC and share due diligence all day long. And also be sure to sign up to Moomoo using the link down in the description below. You can currently get $10 absolutely free and 15 free shares on top of that, worth up to $2,000 each, a grand total of up to $30,000. Alistair tweeted saying followers of Credit Suisse might be interested to know the Swiss National Bank, which backstops the Swiss banking system, just lost 17% of Swiss GDP in the first 9 months. He said the insolvent banks like Credit Suisse might actually have to rescue the insolvent central bank like the Swiss National Bank. Don't forget, over the last 10 years, Credit Suisse has only generated around $20 billion of profit. That means this year alone they've lost $20 billion, if not slightly more, but the Swiss National Bank has lost over $140 billion. That means that Credit Suisse so far has lost significantly less money than the Swiss National Bank, and therefore Credit Suisse may even need to bail out the Swiss National Bank. This is quite literally a scenario of the insolvent trying to rescue the insolvent. But it's not just the Swiss National Bank that can't really afford to offer bailouts, it's also the Fed as well. As Stephen tweeted, he said, "I think people haven't fully processed what 5% interest rates will mean for the $31 trillion of debt." He said it's a simple math equation, but it's sort of like adding a second Defense Department worth of expenses to the budget, except you get nothing in return. The US last year exceeded that national debt cap, which was again pushed up, and the US is already incurring significant interest on that existing debt already. The US obviously recently gave a massive bailout package during the 2020 pandemic and can't really afford to go around bailing out major banks once again. Mark Moss tweeted saying the Fed lost $4.1 billion last month, approximately 10% of the Fed's entire capital base, so it's a lot for them to lose, especially in a singular month. He said at this pace the Fed will be completely insolvent by next spring, at which point they'll require a bailout from the federal government. And this is exactly why the Swiss National Bank and many other hedge funds are actually going long on AMC to hedge against these shorts and prepare for the squeeze. It wouldn't surprise me if secret Fed entities, potentially like BlackRock and Vanguard, are already building a long position on AMC preparing for the squeeze. Hang on, isn't Vanguard one of the largest shareholders of AMC alone? One of the greatest profiteers from the squeeze when it happens will be the Vanguard Group, with 47 million shares of AMC currently held. It's likely this money generated by Vanguard would potentially be given to the Fed to bail out any major banks if it was required. Now, you may have also seen this tweet from FX Hedge that says billions in capital calls or margin calls threaten to wreak havoc on global stocks, bonds, and cash-strapped investors are forced to consider selling their stocks. And as Zeller's tweeted, he said Wall Street rigged the system in their favour, and they kept ramping up the schemes for more money, compounding their leverage and increasing their risk. But now it's all crashing down due to the greed of a wealthy few. On top of that, Egon has tweeted saying the Bank of England risks hurtling towards another bond market crisis, City traders have warned from the Telegraph. He said, so just weeks after a near collapse of the UK financial system, a new severe stress is again emerging. He said the global system is unlikely to survive unless they've hedged against the shorts by going long on AMC. If the UK financial system or the UK pension system does end up collapsing, it's likely to take many UK-based hedge funds and many US-based hedge funds with it as well. And obviously a massive wave of liquidations in US hedge funds would cause the market to fall further, triggering further liquidations and potentially causing the squeeze. Finally, these hedge funds are already starting to feel the pinch, as Zero Hedge tweeted, saying Tiger Global posts a 5.4% October loss, missing the global stock rally. We know that Tiger Global is already down 50 or 54% for this year, so that adds to it and makes over a 60% loss so far. It wouldn't surprise me if Tiger Global management is very, very close to being liquidated, which would cause a further wave of liquidations considering the size of Tiger. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.